we have a more complex policy environment than I anticipated a couple of months, with inflation and debt being much bigger concerns today than they were a couple of months ago.
Let's just stick with the Fed, and by the Fed one can arguably say the ECB, or we could say many of the countries facing inflation. I'm frustrated, Managing Director. It was only a few months ago these very same central bankers were saying transitory. How could they have got it so wrong?
This disconnect between demand and supply is actually more protracted than anybody thought. So we are going to see disruptions all the way in 22, maybe up to 23. And that is the main factor. With more waves of the COVID, of course, these disruptions become more serious. And then nobody made the connection that multiple factors are pushing prices up, like labor markets have changed. Climate shocks have made food more expensive in many places. All of this combined made inflation sticky, and we are where we are.
The Fed chair yesterday, you'll have seen, basically did a version of I'll do whatever it takes to get rid of inflation. Goldman Sachs talks about 4 increases in interest rates in 22. This does not sound, I mean, we could be looking at, if not literally stagflation, at least very low growth with rising rates and inflation.
So you're projecting something that is not entirely out of question. What is positive, though, is that the Fed is acting on data appropriately. They are accelerating the exit from asset purchases. They're bringing forward rate increases, and they're communicating this quite well. If you look at the market reaction to Fed saying all these things, they're coming, it has been smooth. It has been absorbed by markets to a point that some of us are saying maybe markets are too optimistic. Maybe markets are not looking under the hood of this inflation problem, because what worries us is inflation expectations have gone up. Rate increases are not yet catching up with these inflation expectations. So would it be necessary to do more? Maybe. And that is where the threat to growth you described is not trivial. Our assessment is that, one, we have achieved remarkable recovery. What the US has done, for example, to get to a point that unemployment is under 4%, GDP is just about at the level it was in 2019, is a fabulous achievement. And they pumped into the economy so much money that through 22, we're not too worried about demand being strong in the US, and therefore growth at a reasonably sound level.
So, I was listening very closely to your answer, and I'm not asking you, do you think the market's going to fall? But you do give an indication that the fund is concerned that markets are still not pricing in reality.
So in our baseline, we look at US inflation starting to go down in the second quarter. If that is the case, then obviously the Fed would moderate what they do to control it. So we have to stay focused on how data informs our policy making.